All right, so Introduction to Accounting is where we have been. And when we were together at the end of our time last Thursday, we left off talking about this so-called new general ledger. And I made the observation that it's kind of questionable as to whether we really should continue to call it the new general ledger, given that it actually debuted in 2007, and so it's getting ready to celebrate its 10th birthday here pretty soon. But we still do see that term used because it distinguishes from the way SAP ERP used to work. What you are going to start seeing in the future is now, to make this really fun, in S4, which is the newest release of SAP ERP, there is yet another new ledger. And they are referring to it, I forget what term they're using, but they talk about the new system for financial accounting. And later on in the semester, we'll come back and talk about that. But because financial accounting is so critical in an ERP system, a lot of times when new versions come out, that's a part of the system that you see changes in, reflective of requests that customers have made, and so on. So the big upshot here is certainly be familiar with this idea of being able to have multiple ledgers and have the system automatically maintain these non-leading ledgers as you put transactions into your leading ledger, and then also be familiar with some of the facets of functionality supported by the new general ledger, should it show up on a multiple choice question, true, false, or something like that on your midterm exam. Just so happens that, and this is a good place for us to jump in, I have a few questions for us to look at here together by way of review and practice. Subsidiary ledgers are not a part of the general ledger. Is that true or false? That is absolutely true, and please make sure you keep that distinction clear in your mind. I can promise you there'll be at least one question on the midterm exam and probably final exam related to that concept. The subsidiary ledgers are closely related to the general ledger, but they are in fact their own distinct entity. Subledgers exist for all of the following except customer accounts, vendor accounts, assets, liabilities. All of these have subledgers. What's the right answer here? What's that? D. D is correct. We do not have subledgers for liabilities, but we absolutely must have them for customer and vendor accounts, and it is very typical for them to exist for assets as well, but we don't have subledgers for liabilities. There's just really not that much in the way of detail that we would need to record against a liability. We perhaps have monthly or periodic payments against a liability, but it's not like a customer or vendor account that is going to generate the kind of ongoing traffic. This one's an important terminology question. Posting to reconciliation accounts happens automatically based on a process called account reconciliation, determination, calculation, or posting. What's the answer here? Determination, account determination. And whether you have realized it or not, or whether you realized it at the time you did this, a lot of your configuration work, including your most recent lab assignment, had you doing things related to setting up account determination. And that's a critical element in the configuration of the system, because what we don't want to have to do is every time something happens, we don't want to have to run a transaction and manually record debits and credits. We want transactions to automatically post certain entries to accounts just based on, okay, we bought something, okay, we sold something, okay, we shipped a material out. We want to make sure those things are captured. As you have done some of those setting up of things, the exercises I'm referring to have you leverage posting keys, and you're doing things like double clicking on GBB or other codes like that, and then specifying different entities. We'll get into more details of that in future discussions, but the idea there is we can have as many of those or as few of those as we need in our organization. And keep in mind that what you're doing for your lab work is a fairly minimal set of configuration entities. So you can imagine for a large company how much more work would be put into actually setting that up. Yes, sir. Absolutely. Well, you know, I guess I would say this is if you were an accountant, which I don't think you consider yourself to be an accountant, but would you rather be keeping your eye on the big picture and managing the company's overall financial position and helping the company do analysis, or would you be rather walking around with a notebook writing down something every time we shipped a product out? I mean, to me, yeah, it's getting rid of some of the mechanical, mundane elements, but that's not to say that we don't need accountants. I think, in fact, this opens up a lot more opportunities for an accountant than it would be otherwise. So yeah, you're driving out. You know, it's kind of like saying, well, don't cash registers mean that we need fewer people working, you know, the checkout? Well, when you go to Walmart, there seems to be, you know, no shortage of registers with people standing at them. It makes it a little bit quicker and hopefully, you know, solve some problems for us. But it's not like we're able to say, okay, now that we have this, you know, get rid of all the accountants. That's not the case at all here. Debiting an asset account reflects increasing the value of that asset. Is that true or false? True. Got to be ready for questions like this. You're going to see these on the midterm exam, and this is a good example of one that, you know, if you know these things, that's probably going to be about 15 or 20 points on your exam. If you don't know these things, you're going to introduce unnecessary angst into your life. So spend the time to make sure that you know these things so that you can knock them out of the park on the exam. All right, so this is a little bit of a review here to get us set up for the next thing that we're going to talk about here. Keep in mind that a big part of what is done in the domain of financial accounting is very much focused on legal requirements. You know, I mean in no way to insult accountants when I say this, but accounting is not a field where you really prize a lot of creative thinking. You know, the idea is you have to know the law, you have to apply the law, but it's not like you want an accountant that says, oh, I can make it say whatever you want me to make it say. That's the way somebody winds up in jail, okay? So financial accounting focuses a lot on legal requirements, and you want to make sure your company follows those legal requirements. And the distinction of the company code, and I don't know that we've brought out this particular facet of it. The idea is if you think about our company, and we think of it in terms of our client. Well, our client, this is kind of a different way of illustrating than this I have in the past, but if we envision like a little Rubik's Cube kind of structure here, our client might incorporate multiple company codes, company code 1, company code 2, company code 3, and so on. So we could, if we wanted to, compile a consolidated financial statement that would bring all 9 of these company codes together for the sake of seeing how our overall enterprise is doing. And that would make sense. For the sake of our reporting to the SEC, to the IRS, and so on, we do that based on the company code level. What this statement tells us is we cannot think in terms of taking a company code and chopping it into 2 different entities and have those be a valid reporting basis for our legal requirements. If you look at your organization and say, you know, we really could do that. We could split our company in half, and it really is 2 independent companies. if that's the situation we face, those should be different company codes. So the principle here is the entity in our organization that represents the smallest set of things we can put together that we have to do financial accounting for, that's a company code. Tax law, commercial law, accounting standards, all of these are things that you have to be cognizant of when you are thinking about how you are going to set up the company code structure in your organization. So once again, that's why there is a lot of opportunities for accountants in this space that we have been exploring, because computing people aren't going to know tax law and commercial law and accounting standards, but companies are going to want to make sure that their systems are set up in a manner that's consistent with those things. This is also why companies will invest money in these kinds of enterprise systems as a way of making sure that their business practices do conform to industry best practices as far as how things are accounted for. We made this statement before, so this is not anything new for us here, but if we do not have at least one operating company code in our system, we can't do financial accounting. And if we can't do financial accounting, we don't have a live system. We can't ship products in, we can't buy things, because fundamentally everything revolves around money, and keeping track of money is the domain of our financial accountants. So clearly, as hopefully now we have beaten into your brain repeatedly here, when you think company code, you should immediately think financial accounting, and when you think financial accounting, you should immediately think company code. Now, to transition to our next thought here, so clearly financial accounting is important to us. How do we capture financial accounting in the overall system? Well, what we are going to see as the semester evolves is anytime something happens in our organization that has a financial accounting implication, a financial accounting document is created. So what that means, for example, is that we're looking at a given business process, and a given process consists of a sequence of steps. And this step right here, whatever it might be, has a financial accounting implication. I know, therefore, that one of the things that this step is going to do is it's going to create an FI document. Now, it may create or update other documents, but any business process that has a step in it that has a financial accounting implication, that step is going to generate a financial accounting document. And so on any given basis, on any given day, in our organization, even if we're a fairly small organization, we may see thousands of financial accounting documents captured in the system to reflect our ongoing business activities. So let's talk about these financial accounting documents. A financial accounting document is a fairly generic document because it has to have the ability to reflect a wide variety of different kinds of activities. But the focus here is on the financial accounting implication of those activities. So just like other documents that we have looked at, there is a header section and a detail or line item section. And in the header section of a financial accounting document, you'll see a document date, you'll see a document type, and we'll describe more about what that is in a moment. You'll see a document number. Every document has a number. And as a matter of fact, one of the things that you configured in your lab work was document number ranges in the event that you wanted to use different number ranges to be able to easily distinguish different kinds of documents. We have a posting date, which note can be different than the document date. For example, sometimes we might need to go in and create some kind of corrective posting, and so the document date is September 27th, but the event we're actually doing the posting for happened on September 25th, or it might happen on September 29th. So the document date and the posting date may be different. The document date is when this document was created. The posting date is when the event that we are memorializing actually occurred. Notice this, the currency is uniform across the whole document. So we can't have a debit in dollars and a credit in euros. There's going to be a designated currency here that is uniform across the entire document. We'll have a reference number. That gives us the ability to say this document is related to these other things, and to create kind of a chain of reference there. And then, hopefully no surprise at all, we're going to see a company code reflected here. Notice we don't see things like sales areas or purchasing groups or other things like that. The only organizational data that we see on a financial accounting document is the company code, and I trust that's there for obvious reasons. So then when we look down at the detail and line item section, we see, first of all, account numbers and descriptions. That's there basically just to make sure that we don't make a mistake here. The computer would be just fine working with just the account number. But when we put the account number in and press enter, it's going to give us the textual name of that account so that we can kind of use that as a double check. And then there's going to be what's called a posting key. Now the posting key has a number of elements of significance, but the posting key in part will distinguish whether this particular line item is a debit or credit. And as you've seen, it's very common in financial accounting documents for there to be one line that shows a debit amount and then another line that shows a credit amount, and those two lines have the same value specified. But I believe, as we discussed previously and had questions about, you could see three line items here. You could see a credit, let's say, for $3, and then a debit, two different debit lines for $1.50 each. Debits and credits have to equal, but there's no limit on the number of different accounts that could be involved in a particular financial accounting document, although far and away, just one debit and one credit is the more common scenario here. Give me a moment to log into the system, and we'll take a look at this. There are a few things I want to show you about financial accounting documents as our discussion proceeds today. And it would help if I click on the right system here. So it's going to try and launch a system that doesn't exist, so I'll have to give it a second for that. What we are going to look at now is a good example of something that is a critical piece of functionality in the system, but yet most system users, unless they're accountants, probably never actually look at this in great detail here. So let's actually go in and look at some financial accounting documents. So no surprise here, it's under accounting, financial accounting, general ledger, document. This is hard to do here, and then display. Okay, so notice here, it's asking me, okay, give me a document number, which that's kind of, if I knew a document number, I could just type that in here and jump right to that particular document. But I'm going to want to have to do some searching here, so I can click on, oh, my battery's running low. My computer is plugged into the wall, so I don't know. Let's try this. All right, I think that outlet was dead. All right, so let's continue on. So if I click on document list, now it's going to give me the ability to search for accounting documents. Now notice I can search based on company code, I can search based on document number, fiscal year, I could search based on different ledgers, but then notice here, you can imagine, as we said before, there's lots of different documents out there. So if I want to find documents that relate to selling something or buying something or a goods movement, how do I stand a chance of navigating to that? Well, that's where things like document types will help me. And if I know I'm looking for a document, let's say, that relates to a goods movement that happened on a particular day, these give me ways of actually navigating through the huge abundance of documents and actually finding something that I'm looking for. So let's do this for my company code here. So I'll do US 02. And you always have to put in the fiscal year. It's not going to let you get away with leaving that blank. All of our transactions have been this year. So I'll put in 2016 there. And then I'll show you a little trick here for document type. Well, let's just do this. This is going to be another slide here in a moment. But notice all the different kinds of types of financial accounting documents. Asset postings, depreciating postings, customer documents, credit memos, customer invoices, vendor payments, goods receipt, lots of different kinds of documents here. So we'll look at all of them. So I'm going to do this. I'm going to say, show me the documents from AA to ZZ, because as we'll discover in a moment, document types are always 2 letters. So that's going to span the entire scope of documents. And so I'll execute this. And I have the documents that have come from my lab activities. For a real company, this would result in, particularly since we limit it to the entire fiscal year, just a huge amount of documents more would we expect to see here. But you can see my company code. Here's all my different documents. You can see we've got different document number ranges in play here. So it could well be that if I did this every day, that I would immediately know, well, I'm looking for a number that starts with a 5 based on how things are coded in my organization. But then notice these types here. And so let's look at this. For example, what is SA? I think we can do this. And it tells us that an SA document is just a general ledger accounting document. So if I drill into one of these, here we go. Document number, document date, fiscal year, supplies expense, bank account. And you'll notice offsetting amounts there. And notice as well that the way this is shown, we have the line items. You'll notice one of the line items is positive, one of them is negative. How do I know for sure which one is the debit and which one is the credit? I'll put this on the slide here in just a moment, but the posting key tells me this. Notice that I have one line here that says PK40. Well, what's a posting key of 40? A posting key of 40 is just a generic debit entry. And right underneath that posting key of 50 is just a generic credit entry. Notice that there are other posting keys at work here that would allow me to better classify the nature of this particular posting. So if I wanted to go in and particularly search out general or financial accounting documents that related to postings for price differences, maybe where we made some kind of pricing adjustment, I could use the system to navigate in that particular fashion. Notice as well, I don't know that this adds a lot of value here, but I have buttons here at the top, including one called General Ledger View, which just changes the output a little bit here to focus on the debits and credits. I've never really understood why that's worth giving us a whole different screen. It really just, to me, it looks like it moved things around for us. We have other options here to look at the document header, and this is what we talked about before. This shows who created this posting, when they did so, both date and time, and other facts that are uniform across this entire document, including what transaction code actually created this one. and this is an FB50. This was a manual document that was put in by someone doing accounting work. So let's go back and let's just pick a different one here. Let's pick this guy right here. So you notice now we're seeing a accounting document with more than 2 line items: inventory finished goods, costs of goods sold; inventory trading goods, costs of goods sold. So what do you think's going on here? We haven't talked about it in detail, but what's your gut feeling tell you that this document is associated with? What's that? Yeah, we sold something. We sold some finished goods, we sold some trading goods, and so we're pulling them out of inventory, and we're reflecting the value of that in costs of goods sold. And I suspect here that if we look at the header, yeah, the transaction code that created this document is VL02N, which doesn't necessarily probably mean anything to us except for the fact that I know that that particular transaction code is one that we could use to put in a sales order. So the system had a sales order, and in processing that sales order as a part of transaction VL02N, it created this financial accounting document. Any questions about this? All right, so let's talk about some of the things that I just mentioned in just a little bit more detail here so that you have them in your notes. Every financial accounting document will have a document type, and this is a 2-digit code. I don't know that digit is the right word there because these are not numbers, these are 2 letters. So that probably should say 2-letter code that identifies the process that created the document. So for example, DR, those are all customer invoicing related financial accounting documents. DZ are customer payment related documents. These things come in very handy when you suspect there has been an error or a misposting and you need to go back and find these things. These document types determine things like the account type and account number range that can be validly posted to. So as part of your configuration work, you went in and you said, okay, customer invoices are in this number range. And then you set up various kinds of account determinations and you set up reconciliation accounts. And so all of these things taken into account are going to be reflected in the document type that is assigned to a particular financial accounting document. In addition to the document type, there is also an account type that's a 1-letter code that identifies the type of account that's being affected. And these 1-letter codes are things like D for customer, K for vendor, A for asset, and so on. So I'll give you a second to write that down, and then we'll just go look at it again real quick in the system so that we can at least see how this is actually reflected here. So here's my list of documents, and on the slide there it said that DZ is customer payment. So sure enough, I see I have a few documents here of type DZ. So if I double click on that, here I see money coming in from DC Bikes that went into my bank account here. You'll notice that here we have posting key 40, posting key 15. Posting key 40 is just a general debit entry, and notice here for account it's G. So that's just a very generic debit entry to a general ledger account, whereas posting key 15, which is listed here, let's look for that one, that's an incoming payment from a customer account. Now, here's an example of how the new general ledger is much, much, much better for people doing accounting. The old general ledger, if you were going to do this posting manually, not only would you have to specify the accounts and the amounts, you manually had to code in the posting keys. That's now automated in the new general ledger, which means that for the most part, we don't even tend to think of those until it comes time to going and looking for documents if we're trying to find something in the system reflective of a previous activity. It used to be a big part of financial accounting work in the system, but no more is that the case. Any questions about any of this? All right, let's change gears here and move on to another important topic in financial accounting, and that's asset accounting. There are many different ways that we could think of different categories of assets, but one way that we tend to think of them in our ERP system is we think of tangible, intangible, and financial assets. Tangible assets are things that you can touch, equipment, building, furniture, things that have a physical presence to them. Intangible things are things that might be memorialized in documents, for example, but the real item of value doesn't have a physical presence, like a patent, for example. A song might be an asset, but the song itself is actually intangible. And then we have financial assets, which are things that are either cash money or things that can be very quickly converted into cash money, like stocks, bonds, securities, receivable money coming in from customers, and things of that sort. So when we talk about asset accounting, these are the things that we tend to focus on. And as we already mentioned, this is a major branch of financial accounting. And as we also observed, it is also something that we will commonly see subsidiary ledgers associated with. We can further break down tangible assets into categories like fixed assets, leased assets, assets under construction. Fixed asset would be the building that we are in. A leased asset might be a piece of equipment or a vehicle, for example, that we currently own and have possession of, but we are not the exclusive owner of. We just have temporary ownership of it. Asset under construction is pretty self-descriptive. The new football stadium here on campus would be an example of an asset under construction, quite obviously. Now, every asset is tracked in its own subledger account. Why do we need that? Well, as we're going to establish here in a moment, because of the ongoing transaction stream that will result from activities associated with that assets. So, if every asset is reflected in its own subledger, one of the things that tells us is that an asset is assigned to a company code. So we might have a large conglomerate that has different company codes that are closely associated with one another, but yet when we actually think about the assets in play, every one of those assets is going to be assigned to its own distinct company code. We have not yet talked about business areas. We'll get to that, I'm confident, before our day is done. But business areas are also something that assets can be assigned to. And then we haven't talked much about cost centers. We'll get to that perhaps today. Assets can be tracked in terms of cost centers as well. Now, we don't want to, in a large organization, spend our time really focusing on every individual asset. You could imagine, for example, a large trucking company that might own over 100 semi-trucks. Well, it's going to get very, very tedious if we think of doing accounting in terms of every individual asset. So instead, what we will do is we will take like kinds of assets and we will group them into an asset class. And generally speaking then, once we do that, every asset class is going to be mapped to its own general ledger reconciliation account. So if we think of it in this fashion, let's use my example here of a company that has many, many different semi-trucks that they use as a part of their operation. Every individual semi would have its own subsidiary account and a subsidiary ledger. So that's reflected here. But we would take all of these semi-trucks and group them together in an asset class that who knows what we'd call it. I'll just call it semi-trucks. And this asset class would be mapped to a reconciliation account that is, of course, part of our general ledger. So what this allows us to very easily do is we buy a new truck, we sell off a truck, we bring that in, or we delete that from the asset class. And then once we do that, then our mapping to our general ledger account is handled for us automatically. Now, what financial statement is this guy going to show up on? We've talked about this, not on this slide, but where is this going to show up? What financial statement? This is a balance sheet account. Why is this a balance sheet account? Yeah, balance sheet shows assets, liabilities, and equity, and we're talking about assets here. So on our balance sheet, we might see a line item called semi-trucks or vehicles or something like that that would be reflective of what I'm showing here in this particular diagram. There are three primary transaction types associated with assets. We have the acquisition of an asset, we have the depreciation of the asset, and then we have the retirement of the asset. So let's talk about those for a moment. Of those three, perhaps the only one that has anything notable of interest would be depreciation. The other elements of this are pretty straightforward. We'll talk about each of them, but the only one of these that has any complexity, perhaps, is the depreciation option. So let's do some more financial accounting postings. We go out and we are a company that engages in woodworking. So we go out and we buy a $10,000 lathe from a company called Custom Millworks. And this is the first transaction we have seen that both halves of the transaction are actually going to originate in subledger accounts. Because $10,000 we'll assume is pretty good money to spend for an asset. And so we would definitely value this as an asset in our financial record keeping. And so this particular lathe is going to get its own asset account. And we will typically, in organizations, put an asset tag on this particular asset that, in essence, gives this piece of equipment its own distinct number. Now, we're assuming that in the organization I'm using here for the slide, that we only have 3-digit asset tags. We don't have thousands and thousands of lathes here, but this could be a much longer number here. So we acquired lathe number 146, and we did so by buying this on credit from Custom Millworks. So what does that mean? Well, we now have an asset that we did not have a few moments ago. So we know that we are going to begin by debiting this lathe account by $10,000. And I now have a liability I did not have a few moments ago, which is I have a debt to Custom Millworks for $10,000 where I am going to be paying for this. So notice the valuation of this asset is very, very straightforward. It's what we paid for it. We bought it for $10,000, so that is the acquisition cost for this particular item. But these are both subledgers. So these subledgers, in fact, map to reconciliation accounts in the general ledger. Now, the vendor account's pretty straightforward. This is going to map to, in our general ledger account, our accounts payable account. So we'll have that automatic posting there, and we'll assume that our lathe is in an asset group that we are using to represent factory equipment, and so this now will be reflected in this automatic posting here. And so we now have a debit populating up to factory equipment for $10,000. Any questions about this? All right, so this is a very, very typical situation. But let me describe for you a different scenario. Suppose, well, in most organizations, first of all, we follow a process by which we onboard a vendor. One of the reasons why companies will do that is as a way of preventing fraud. They don't want any old employee to just be able to go into the system and create a new vendor. I sometimes have told this story, so some of you may have heard it before. I don't think I've told it in this class this semester. But when I was in high school, I worked at a hotel restaurant in my hometown and worked there for quite a while and left one year to go off to college. And when I came back after the first year, during the summer, I went back to work there. Went off to college my sophomore year, came back home, and went to see the general manager. And I inquired where he was, and everybody was like, you didn't know what happened? And this was before the internet was commonly available, so there was no internet or World Wide Web. So I was like totally out of the loop. But the year before, shortly after I left to go back to college, he disappeared. And at first people were like, did he get kidnapped? Did he get killed? What's going on? He's just gone. And he had a company car. His company car was gone. Well, they put out whatever the police do, an APB or whatever, to try and find him. And eventually his vehicle showed up like 2 states away, just abandoned. And of course that raised questions, did he get kidnapped or what's going on? Well, that launched an investigation. And auditors were brought in and started going through the company records and began to realize that, whoa, I don't know what just happened there, began to realize that a whole bunch of money was missing. And as they started tracing through it, they discovered that basically over the period of about the previous 4 years, he had stolen several $1 million from the organization. And the way that he had done that was very, very poor controls. He had the ability to sign checks and to pay vendors, and there was no one else that was kind of looking over his shoulders. So he created several dummy companies and ordered things from those dummy companies and paid those dummy companies, which just went into a bank account that was totally under his control. And when he had accrued enough money that he thought he could disappear, he went, took all of that money, moved it to other accounts outside of the United States, and then disappeared with, I think the FBI estimated that he got between $3 and $4 million. And he did that totally based on this ability to create dummy accounts and to pay those companies, and no one was the wiser. So for that reason, companies normally keep pretty good controls over somebody being able to go in and create a new vendor. And it might require, for example, us pulling a credit report, a Dun & Bradstreet report, or something else to verify this is a bona fide company and so on. So there's a lot of work that goes along with setting up a vendor account. So here's my question for you. Suppose I want to buy this lathe, and I want to buy it from Custom Millworks, but I'm just guessing that I will probably never buy another lathe from them again. Maybe I only buy a lathe every 20 years in my company. This is a transaction that I just don't see recurring. So what happens if I want to engage in this transaction, but I don't want to set up that vendor account? Is there a way that I can do this? And the answer to that is yes. We can do that through what's called the clearing account. Now, we're talking about this concept in the context of buying an asset. but there are actually lots of other accounting contexts in which we can use clearing accounts in the fashion similar to what I am describing here. So we could buy an asset through the use of a clearing account. What is a clearing account? A clearing account is an account that gets temporary postings in it to allow us to achieve time synchronization between transactions, or to record additional data on process steps. Now, this is not a perfect metaphor, but there's an element of this that would be similar in a computing context to a semaphore, where basically if there's money showing up in a clearing account, that signals me that, oh, a transaction is in process, because once that transaction is over, the clearing account will be back to a zero balance. So the whole idea of a clearing account is basically it's a temporary kind of account that I can either debit or credit until the next step in the process occurs that's going to offset that and put my clearing account back to a zero balance. So I can use clearing accounts when I'm buying things, when I'm selling things, or in other processes. Now, clearing accounts have as one of their facets, I'm going to lose some of the detail that I would have if I were doing this using the general ledger in a more typical fashion. But I use these clearing accounts for just those occasional transactions where I need to get stuff done without having to take time to create new subsidiary ledger accounts or otherwise disrupting my normal flow of accounting processes. So we tend to use these for those occasional just one-time transactions where maybe I want to sell something to a customer, but it's going to be a one-time transaction, and so I don't want to set up a customer account. And I'm not legally required to set up a customer account, we'll assume in this scenario, so I could use a clearing account to do that. You know, imagine for an example, we're a company that pretty much all of our orders get shipped out by way of our trucking line, and we deliver to customers. Well, one day, somebody shows up at my factory and says, hey, I'd like to buy 5 of those things over there. And normally we don't have that happen. No one ever comes to our factory. But we want to sell those 5 things to this person who's just walked in the door. What we're selling is not in any way sensitive, so we don't have to worry about like them being a terrorist and using it to blow up a building. It's just stuff we have. We want to sell it to them, but we don't want to set up a customer account for them. A clearing account would let us manage that type of transaction. So how does this work? And the whole point of this is we're going to buy a $5,000 shredder on credit. But this is a one-time transaction, and I do not want to take the time to set up a vendor account. So I can, at my option, elect not to do so and instead use a clearing account. Now, the danger here is I got to make sure I don't forget to pay this bill. And I have to make sure that, you know, this is probably not something I want to use with great frequency, because normally I'd want to be able to profile my vendor and track their performance and so on. So how does this transaction play out now? I buy the shredder, still $5,000, or $5,000 in this case. So here's my shredder number 182. So I know I'm going to be debiting this account for the $5,000 for the shredder. And this populates up to a reconciliation account called office equipment. So the debit portion of my transaction looks the same. But now instead of crediting the vendor subledger account, I'm going to credit an account called asset acquisition clearing account. And this is going to be the offsetting $5,000 credit. And this account right here is not a reconciliation account. This is a direct posting account. And you saw in your general ledger, perhaps you've noticed, you do have some accounts that even in their name, they say name of account and then next to it direct post. So that's an indication that that is an account that has the ability to serve, much like what we're doing here. Okay? So just a different way of doing this without employing a vendor subledger account. So we get an invoice for this shredder. Well, what happens now? Well, you'll remember from a moment ago, our asset acquisition clearing account had a $5,000 credit balance on it. By virtue of the fact that that account is not a zero balance, we're waiting for something else to happen. We know that something is in process. And that something that's in process is the buying of this shredder, so we get an invoice for the shredder. Well, what's going to happen here? Now we have another transaction here where when the invoice comes, we're going to debit our clearing account and credit miscellaneous payables. So at this moment now, our clearing account has been wiped out, and we have a specific invoice in hand from this particular vendor that we know we're going to be paying here. So there's just one step left, and that's actually paying for the shredder. And when I pay for the shredder, I'm going to be crediting my bank account. Don't know why I typed in the numbers here as opposed to writing them in like I did the last, but nonetheless, we have the miscellaneous payables now, which are being debited $5,000, and my bank account, which is being credited. And if we actually trace back this entire sequence, we'd see that what we were left with is our shredder account, our shredder asset account has a $5,000 balance on it of a debit, and my bank account, when all was said and done, is out $5,000. So that's where I wound up, but you notice it took me a few steps to actually get there in the overall process. This is an example of how I can buy things, and in this case I bought an asset, but I did so by way of using a clearing account as opposed to a vendor account. So just to kind of reiterate here, why did we do this? Why did we need to use a clearing account? Why couldn't we just forget about the clearing account and do the transactions directly to miscellaneous payables and so on? Well, what we're going to see now in a few transactions this semester is often we will use accounts and balances in an account to achieve time synchronization. And in particular, what I want to have happen here is there's two different things that are very important to me. One is I don't want to pay for this until I have the asset in hand, until I've gotten an invoice. So imagine, for example, I work in accounts payable, and I just work in that room. And apart from that, I'm not allowed to communicate with anybody else in my organization about anything. That would be a really horrible job and a really horrible way of doing business. But for my hypothetical example, let's just imagine that's some scenario. So I have no idea whether or not we have this shredder or not. All I know is I have a bill for this shredder. But I don't want to pay for this bill until I know that we do have the shredder. So the clearing account allows me to know, okay, I have the asset and I have the invoice, it's safe to pay. But if I have the asset, no invoice, I don't pay. If I have the invoice, no asset, I don't pay. But once I have both of those things, I pay. Later on this semester, we will cover another kind of account that's very similar to this, which is called a GRIR account. And a GRIR account is used for exactly this kind of synchronization. This stands for goods receipt and invoice receipt. And it allows me to check, okay, which of these things do I have? Do I have the stuff and do I have the bill? And once I have both the stuff and the bill, then I pay. But the principle here is really, really straightforward. I don't want to pay until I have the stuff. because if I pay and don't have it, I may never get it. So my biggest leverage here comes from holding on to my money as long as I possibly can. So I know that when the asset acquisition clearing account is cleared, it has a zero balance in terms of this particular transaction sequence. I know it's safe for me to submit payment. So once again, if I'm an accounts payable worker and I have the ability to look at the accounts but not talk to anyone else in my organization, this account is really, really important to me. And this goes back to where I said this is kind of like a semaphore, because this tells me, okay, you can go ahead and pay this. And it gives me a way to achieve the synchronization that I desire in the transaction overall. Questions about any of this? Let's come back to something we mentioned a few minutes ago, which is asset depreciation. Now, it's been a long time since I have taken a financial accounting course, but I seem to recall that, like, in Financial Accounting Principles 1, you spend like a week or so talking about asset depreciation. And you talk about all the different kinds of ways you can depreciate an asset and pros and cons and things like that. We're obviously not going to spend a lot of time on that, but this is a fairly foundational financial accounting concept that is applied in every organization. And the basic principle of this is most fixed assets value go down over time. So in our accounting records, we want to reflect the true value of the asset. It's kind of a parallel to the adage of when you buy a new car, as soon as you drive it off the lot, you know, the value of that car has gone down potentially dramatically. Well, if I as a company go out and buy a computer for $2,000, after I've owned that computer for 6 months, probably not worth $2,000 anymore. Now, there are exceptions to this. There are some assets that appreciate and gain in value over time, but generally speaking, most of the things that we possess as an organization will in fact depreciate over time. Depreciation is an expense, and it basically reflects the company being charged for using that asset over time. So for example, if I bought a laptop and at the time I bought it, I paid $2,000. And here we are 6 months later, and I would say that the value of that laptop is now $1,500. That $500 difference is essentially going to be my charge for using that laptop for the last 6 months. So depreciation is an expense, and it basically reflects me being charged for using the asset over time. Now, there are some fundamental concepts that go into the calculation of how we depreciate it. One of the things that we look at is how long is an asset expected to last? So, for example, I go to a dealership to buy a semi-truck, and I purchase a particular truck, and one of the things that the documentation would tell me or my historical experience would tell me is how long is that asset going to be useful. And so I might determine that this particular truck we're looking at, I think I can get 5 years of use out of it. Now, I cannot just arbitrarily assign useful life to things, but I do have some flexibility here. You know, I can leverage my experience, and I can leverage standard industry practices in making this determination. The next thing I would look at is what's the residual value? When I am done using this at the end of 5 years, how much is this truck going to be worth? And I might say, well, you know, at the end of 5 years, I would want to sell this truck because it's probably no longer reliable. There probably are better trucks that I could buy 5 years down the road. But I do think I could sell this truck. And based on past experience, and I have no idea what semi-trucks are worth, I might say, you know, I can get, at the end of 5 years when I sell it, I can get $15,000. So that's the residual value of this particular truck. So we have the useful life, we have the residual value, we have the book value. Now the book value starts out as what I paid for the truck. Once again, I have no idea what a semi-truck costs. Is $150,000, is that like just way too high, way too low, or about right? About right? Okay. All right, so 150, it's not, at least it's in the right ballpark here. All right, so the scenario is $150,000 I'm paying for a truck. I expect to be able to use it for 5 years, and at the end of 5 years, I expect to get $15,000 when I sell it. So useful life, residual value, book value. And then what's going to happen here is, essentially, I figure out how I want to depreciate this. So I don't really have a slide for this. Let's talk about this. One of the ways that I can do this is called straight line depreciation. Straight line depreciation is really, really easy. I take the starting value of the truck and I subtract the value at the end of its life. So this is what? $135,000. Now so here's the idea. At the end of 5 years, I want the value of this asset to be $15,000. So here I am, if you will, day one. My books reflect an asset for $150,000. And then down here is day 5 years plus 1. I want the value here to be $15,000. So how do I get from here to here? Well, what's going to happen is once a year, I run a transaction called the depreciation posting run. And what that's going to do is that's going to go through and look at every one of my assets and put into my general ledger postings associated with depreciation. Now, how's it going to do that? Well, we said that the difference between here and here, the difference between what I paid for it and what I can eventually sell it for, is $135,000. And we further said that the useful life of this is 5 years. So in straight line depreciation, I just divide that by 5. And so that's going to be what? 2 is 10. What's it, 27,000? All right, so here's year one. I'm going to subtract $27,000 for this. So this would be $123,000. And there's going to be a charge to depreciation expense. And then year two is what, 96,000? You said this was 27,000, right? Okay. And then year three, and you can see we're just continuing basically every year in straight line depreciation. We're going to write off $27,000 to get us from our initial book value to our book value at the end of its residual life. The term book value just describes the value of the asset at any given point in time. So in year two, if someone said, hey, how much is that truck worth? I'd say, oh, it's worth $96,000. Now, you don't have to depreciate using straight line. This is where we get some flexibility here. There are all kinds of other allowable patterns for depreciation, which is why companies will not only engage in depreciation posting runs, you can kind of do a little simulation to figure out which method of depreciating a set of assets is actually best for your organization over time. Yes, sir. Roger? So the metal, is it a raw material? Okay. I mean, we know for items that we're buying that are raw materials, if it like corrodes, but as a part of the manufacturing process, we cure the corrosion, if you will, we don't really depreciate that. If it's something that's going to be sitting around for 6 months, we're probably not going to be depreciating it. We're thinking of things that we're going to be hanging on to for a much longer period of time, buildings, vehicles, equipment, and so on. I wouldn't overcomplicate this, but there are nuances of this that are beyond what we would want to get into. But the basic principle here is what depreciation allows us to do is reflect the current value of assets, and this is our mechanism with these annual depreciation posting runs for actually reflecting that in our financial statements. Yes, sir, Ben?
Well, my question kind of piggybacks off of his.
Okay.
It's like Eastman would be kind of an example where they buy maybe chemical tanks, where maybe they experiment with new chemicals. You wouldn't know the depreciation, how much it depreciates that tank. So I was wondering how they account for that.
Yeah, there's a lot of where you can rely on industry norms. You can rely on the vendor who sold it to you telling you this is going to last you 10 years. Now, does it ever happen where you thought it was going to last 10 years and you discover that after year 5 it's worthless? Yeah, and you're going to have to do postings to reflect the current value of that. This kind of assumes inherently the normal life of this. It also means that at the end of 5 years, if we can get somebody to pay us $25,000 for this truck, we're not going to say, oh, no, you can only pay us 15. There's going to be actual postings that would supplement these that would allow us to handle those situations. Okay. Other questions? Okay, we're almost done with financial accounting. There's one concept that we have not talked about that is important for us to realize. We have, and I'll go back to the diagram that I drew earlier in our time together today that kind of resembles a Rubik's Cube where the client is the whole cube, and then every one of these is an independent company code. Well, we said that what distinguishes independent company codes one from another are legal requirements that come to us from the IRS, the SEC, or other similar international bodies. Suppose, however, for our benefit, or for some kind of specialized activity we're doing, we want to be able to generate financial statements that would perhaps bring together activities of these two company codes. Or perhaps we would want to be able to generate a financial statement that would bring together a part of one company code with a part of another company code and create a structure kind of like this oddball little square I drew here. Suppose we needed to do that. How do we do that? We can do that through business areas. Now, before we step into the details of this, let's think about why we have this. Everything in financial accounting that we've said up to this point is that financial accounting revolves around the company code, and that keeps us in compliance with the law. It helps us do what we need to do. But the fact is, sometimes for our own internal purposes, or based on contracts or relationships that we have entered into, sometimes we need to be able to carve up this pie in slightly different ways. We're not saying we're going to do that for the sake of filing our taxes with the government. We're saying that sometimes this is just for our own benefit, for internal contracts and calculations and so on. Business areas give us that flexibility. Business areas allow us to create really both internal and external reports that span across company codes, should we ever find that we're required to do that. So this is kind of like okay, we know that financial accounting normally focuses on the company codes, and the company codes don't go away, but if you ever need to impose on top of the company codes some other kind of consolidating structure, business areas give us the ability to do that. Now, business areas are entirely optional, and many organizations have no need for them at all. But like I said, maybe in our business, we do need to bring together activities that are housed in different company codes for the sake of some kind of report we have to generate for a governmental agency, just for our own benefit and tracking or whatever have you. So business areas let us do that, and they're very, very flexible to give us the maximum ability to say, okay, I'm going to take this part of this, and 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 we're going to make all of that a business area. We can do that. Now, business areas typically allow us to differentiate company structures based on product lines or subsidiaries. Okay, so I don't know what my diagram here represents, but let's assume that it represents a conglomerate like PepsiCo. And let's further assume that for the PepsiCo companies, that a lot of these companies sell products targeted at children. And let's assume that a new law is passed that requires us to report business activities that particularly target children in those activities. So we go through and say, okay, this portion of this company is child-related, and this portion of this child-related, 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 and we go through and we designate that. And now we could generate a report on all of our child-related activities as it spans across distinct company codes in our overall conglomerate. That's what we can do here with business areas. Sometimes it might be that I use distinct business areas inside of a company code. You know, here's my company code, and I've organized myself into divisions, and I'm using sales areas like we've talked about before. So those divisions maybe are illustrated here with my black lines. But I further, for the sake of some other company activities, want to be able to draw the lines in a different way and think about, you know, this half of the company versus this half of the company. And I don't know what the arbitrary division is, but it's just a different way of dividing up the company. I can do that. I can do that with these business areas. Business areas, company code independent. I can post against a business area from any company code, and that's kind of illustrated with my first diagram here. It can go in and pull out child-related activities from different company codes, which implies, of course, that it can span across those. Typically, even though it says business areas facilitate external reporting, as we've established, it can give us the ability to do that. But I would suggest to you that where companies perhaps more typically think about business areas is as a way of carving out a part of their organization for internal purposes. Let's say, here's a hypothetical scenario. Here's company code 9. And we're a pretty big company code, and we're thinking about spinning off part of our organization and selling it to another company. So we can take this part of the company right here, and in the short run, we could think of this as a business area. And we can do calculations on that business area. We can figure out its finances, use it to value that business area, with the idea being that at some point in the future, we might sell that to another company, and then that business area becomes not a part of our company code at all anymore. So if we need flexibility, company codes are not about flexibility. Company codes are about legal requirements. But if I need flexibility, business areas give me a way to overlay a logical structure on top of these company codes that give me that flexibility. I don't think in your lab exercises we do anything with business areas. There's really no need for us to do anything So apart from this discussion and other references to it we make in the future, I don't know that you're actually going to see it in any of your lab work. Questions? All right, when we get together on Thursday, we'll spend just a little bit of time talking about cost accounting, and then we'll move on to our next discussion.